The steadfast belief that inflation will eventually return to the 2% target has shattered, plunging global consumers into despair. As of 2026, structural inflation driven by deglobalization and climate costs has become permanently embedded in the global economy. Everyday individuals who relied on stagnant wages are experiencing severe panic as their real purchasing power rapidly evaporates. The global market is a ruthless reflection of macroeconomic realities that do not care about our hopes for cheaper living costs. It has been painfully proven that the vague expectation of returning to the pre-pandemic low-cost era is a dangerous delusion. Why has the global economy entered a prolonged cycle of high costs and diminished living standards instead of stabilizing? Today, through this 10-part series, we condense the cruel truth based on objective macroeconomic data and current global trends. Please coldly face the painful reality of the 2026 global market, a truth that is uncomfortable but absolutely necessary for survival. The decisive trigger for the current global financial volatility is the severe divergence in monetary policies among major central banks. Unlike the synchronized rate hikes of the past, institutions like the Fed, ECB, and BOJ are now moving in completely opposite directions. This lack of coordination has become a massive signal for speculative capital to exploit interest rate differentials, causing extreme currency fluctuations. Contrary to the intention of economic stabilization, the suppressed volatility has exploded like a broken dam across foreign exchange markets. As soon as the policy gaps widened, institutional investors began aggressive carry trades, devastating vulnerable emerging market currencies. An artificially coordinated global financial system bounces back with the most destructive force the moment central banks prioritize domestic survival. Ultimately, capital instantly flows into the highest yielding, safest sovereign bonds the moment interest rate differentials widen. The fatal miscalculation of traditional investors was ignoring the objective data of the massive capital drain toward artificial intelligence. The explosive demand for data centers and energy infrastructure in 2026 has resulted in a complete drying up of funding for traditional industries. Furthermore, the insane capital expenditure required for semiconductors and power grids has created an era where only megacap tech companies can survive. Traditional businesses cannot secure affordable loans due to the crowding out effect, forcing investors to turn away from conventional sectors. The skyrocketing valuations of AI infrastructure act as a massive black hole, sucking up global liquidity and starving everything else. The clear statistical truth is that the capital required for the future tech transition is infinite, but available global liquidity is strictly limited. Expecting broad market growth in an environment where a single sector monopolizes all funding completely denies the reality of the current economy. A cruel paradox has occurred where the extended period of high interest rates has finally triggered a massive wave of corporate distress. Because of the higher-for-longer regime, companies that survived on cheap debt are now hitting a maturity wall with refinancing costs at record highs. Pushed to the edge, zombie companies are being forced into bankruptcy, sending shockwaves through the global credit and employment markets. Added to this is a severe liquidity crunch, where risk-averse banks are locking their vaults and refusing to issue new corporate loans. While the need for emergency funding has exploded due to soaring operating costs, prime credit is vanishing, leaving distressed firms with exorbitant private credit rates. An abnormal structure is completed where just a few major corporate defaults cause credit spreads for the entire market to spike drastically. The combination of high debt burdens and strict lending standards has laid the most perfect and cruel foundation for a corporate default cycle. The most painful characteristic of this current economic cycle is the strict and extreme polarization, where wealth is highly concentrated. While emerging markets and small-cap stocks struggle in a swamp of stagnation, the top 1% of global megacap corporations pierce through all-time highs. Feeling the burden of economic uncertainty, global capital has disposed of risky assets and consolidated into a few bulletproof monopoly companies. Even as the absolute growth of the global economy slows down, the demand for shares in these irreplaceable tech monopolies is exploding. The trap of averages, believing if the broader economy slows, big tech will fall too, has handed the greatest despair to retail investors. Now, the global financial market has perfectly entered a strict capitalist caste system where only the absolute winners continue to rise endlessly. The price of underestimating the value of irreplaceable market dominance and monopoly pricing power is far too harsh. The one-dimensional economic common sense that the US dollar is the only eternal safe haven has blinded many traditional investors. As geopolitical sanctions escalated, central banks worldwide aggressively shifted their reserves from fiat currency directly into physical gold and alternative assets. The weaponization of global financial systems means that relying solely on fiat currency is becoming increasingly risky for sovereign nations. The global monetary system is inherently shifting toward multipolarity, making the long-term devaluation of fiat and the rise of hard money inevitable. Wealth stored entirely in traditional government bonds is slowly having its purchasing power robbed by structural inflation and currency debasement. The naive formula that the current fiat system will remain unchallenged fails entirely before the massive wave of global geopolitical realignment. Holding only fiat currency without the defensive shield of scarce, neutral assets results in the tragedy of severe wealth erosion. For those who blindly expected a return to cheap labor and globalization, all that remains are expensive production costs and shrinking margins. The passive mindset that ignored the massive demographic cliff of aging populations in major economies was a fatal blind spot. People who waited for supply chains to normalize ultimately missed the fact that the global working-age population is structurally declining. The era of unlimited, cheap global labor is over, and we realize too late that the leverage has permanently shifted to the workers. The arrogance of assuming production costs would drop causes businesses to lose their competitive edge or face permanent margin compression. If you are analyzing the global economy, the reality of demographic headwinds and chronic labor shortages is a problem for right now. You must admit the painful mistake of viewing economic growth solely through the lens of technological advancement while ignoring human demographics. From the past to the present, policies attempting to artificially build tariff walls and domesticate supply chains have ultimately caused massive inflation. Punitive tariffs locked up efficient global trade, and massive industrial subsidies became the kindling that instantly exploded national deficits. Governments are proving themselves that they cannot permanently bend the absolute laws of comparative advantage with artificial trade barriers. The reality is that geopolitical fragmentation does not protect domestic consumers, it merely forces them to pay the price of inefficiency. Blindly trusting political rhetoric about economic independence while ignoring the reality of skyrocketing import costs is extremely dangerous. We must never forget the objective fact that the majestic flow of global interconnectedness makes isolationism incredibly expensive and painful. The wealth of a nation is not protected by closing borders, but only through relentless innovation and maintaining global competitiveness. There is no time to merely despair. If the traditional 60-40 portfolio is dead, you must re-evaluate the best possible asset allocation suited for this era. Instead of relying on passive index funds, target sectors with strong pricing power and the ability to pass costs on to consumers. Embracing alternative investments and real assets as a hedge against fiat debasement is a solid niche strategy to grow wealth. If you are heavily concentrated in one geography, you must execute a diversification strategy to take advantage of emerging market growth. Strategically utilize tax-advantaged structures and global mobility to upgrade your financial resilience without unnecessary capital leakage. Abandon the vanity of finding a risk-free yield, and deeply value the defensive power of a diversified, inflation-resistant portfolio. Only those who sharply penetrate the market inefficiencies that open up during macroeconomic regime changes can climb the ladder of global wealth. Through this 10-part series, we condense the cold data and facts of the 2026 global economic market that shattered outdated investment paradigms. Structural inflation, central bank divergence, and geopolitical fragmentation all prove the truth that the era of easy money is permanently over. Resentful complaints wishing for a return to the pre-2020 economic environment will not protect your portfolio by a single cent. Financial literacy is not simple speculation, but the most perfect concrete shield to protect your capital and family's well-being from macroeconomic chaos. Now, turn off the emotional switch and walk right into the center of the market with cold rationality and execution based strictly on numbers. Only those who have overcome their darkest fears and adapted to the new regime can grasp the heavy and sweet spoils of global capitalism. Whether you will be crushed by the massive wave of the global economy, or grab a surfboard and ride the volatility to wealth, is entirely up to your choice.